Hi, this is Chuck, better known as Low Trade. Tonight I'm going to do a complete evaluation on Nike. Um, Last week I have a friend who knows I dabble, and he had mentioned to me that he had recently taken a position in Nike and asked what I thought. So, being a trader, I just threw up a quick look chart, and the minute that I saw that the price had climbed up and broken out above 80, the investor's rule of thumb was right off the cuff, came out of my mouth. And that is, if the price hits 80, eventually it'll hit 120. So this is the first thing I said because I didn't really have time to do anything with it other than just take a quick look. That's the Warren Buffett sort of type of investing where you buy and hold for years. It may take years to go from 80 to 120, but the rule of thumb is for long-term investing, if a stock hits $80, eventually it'll hit 120. So that's all I knew about it. I never looked at Nike before, so that's what I told him. Now, I'm going to, this evaluation, or this video is probably going to, what do we got? This video is probably going to be fairly long because last night I saw him again and he mentioned, hey, it's above 92.50 already. So tonight I took a look at it, and this candle right here gave me some concern, because what happened was we have a long uptrend and gapped open, and immediately, without no higher spike, no continuation during the day to carry it higher, it immediately retraced back to where it was. That to me is an automatic sign of exhaustion, that the people that have been supporting this climb up here is getting exhausted. And naturally, short term, I've just got done posting often about this V bottom pattern, where your first target is reaching the previous high, which it did last week when he mentioned it to me. So right in here is when I first looked at it, and right here is where it broke 80, and it broke it on a strong move. So my off the cuff right now with this is saying you better take a better look, because what's going to happen with your V bottom is you got your momentum carrying it up, and naturally you're going to have your wash back. You got to expect that with the pattern. So you're going to get your wash back down to around 90. Now there's a gap right here, so it'll probably ended up come down to 89. Okay, and then if all the long-term investors like what's been happening with this, okay, then it should, looking at the V bottom pattern, it should, after wash back, should continue back up on the same angle there. But so right now we're in the position that, okay, it looks like we're at the top of the washback. It's going to come back down and it's going to go back up. Chuck, take a better look at it. Let's look at this thing long term and see if it's worth a long-term investment. So, which I had never done. I had never done a long-term investment. I just did off-the-cuff type thing. So let's take a look at long-term. I got a monthly here, which is 1, 2, 3, 4, 5, 6, working on 6 years. And as you can see, this has been a good investment. It's continuing and continuing and continuing. Now, there's a long-term pattern called the bump and run. What the bump and run tells you is if you follow your trend and draw your trend, here we go again, and draw your trend line, okay, if it bumps and goes on a high, and goes at a 45-degree angle up, that's called a bump and run. Eventually what you can expect when you see that is that's going to come down and break the new extreme trend line, and it's going to retrace down to the lower trend line. Now, to give you a little support on this happening on almost every stock, if you take a look at the weekly, we'll draw our line here. We'll draw our trend line here. Okay, up and up and up. Now, you noticed every time that it bumps and runs up, it comes back down to the trend line. And then it bumps up and comes back down to the trend line. And it bumps up at a sharp angle, it comes back to the trend line. So that's basically what I'm saying. Long term, what we have on this, again, a 2-year chart with a weekly, again, what we're having is we're peaking here. We're going to expect it to come back to the trend line. So if you're an investor, okay, you use financials and fundamentals, okay, to evaluate long term. Use a midterm chart. Say, well, a long-term chart is any chart that's over 6 months. And for comfort, the midterm chart is anything 3 months. And a short-term chart is what's happening with the price action for 1 month. Okay? So we're looking at right now a midterm chart, and we're seeing a bump. Okay, we're seeing a bump and run, warning you that it's going to come back down. So this made me go back and look at a closer short-term chart, so I could evaluate the thing completely instead of just going off the cuff. So there's our 6-month chart. Now, if we take this and draw our trend line, okay, we're down at the 80s. Now you gotta remember, here's where she bumps, and here, whoops. Here's where she bumps, and here's our run, the high angle, okay? This exhaustion indication up here is what makes me think that it's liable to start coming back down. Now, I'm a take profits guy. He's a long hold guy. So long term, eventually, even if this does come all the way back to trend, we're still above the 80 line where it broke out. Eventually, over the next few years, you can expect, if you hold this thing, that it's going to reach 120 because of the rule of thumb. But presently, okay, if you're a buy and hold guy that usually position trades, say, every 3 months, now's the time to take your profits on this. So let's step down and do some TA evaluation of what now. Long, still off the cuff hold. The thing eventually is going to reach 120, but right now be a great time to take a little bit of profits off of this thing. Now I want to get into, let's go back to this chart. Now I want to get into, I'm a trader. He's a position trader. He's a hold for 3 months maybe type of guy. I find nothing wrong with holding a core position for a long period of time, okay? Core position for a long period of time, expecting this trend to keep going, expecting this trend to keep going, okay? But mathematically, if you hold a core position and swing trade a short-term position or a mid-term position, like 3 months, 1, 2, 3 months, up and down, up and down, up and down. Okay, if you swing trade your core position while you're going along, the synergy of the added gain in this ramp up and selling once the reversal starts, this ramp up and selling once the reversal stops. Now you take these swing trades and you add them to your core position, and over long term, the synergy of the two is giving you a much greater return than if you just bought and hold and never paid any attention to the rest of it. So Hence, I'm sure you read my evaluation prior to this video, and what I'm saying is now's the time, okay, to take some profits, hold a core position, and expect this thing possibly to come down. So let's get into the short-term and mid-term evaluation. Short-term, mid-term, okay, there's your 3-month chart. We have here a breakout above the 80, which is super positive for long term. Investors finally feel that this thing is super, okay? But as you can see, it started to retrace back to the 80, and then bang, something happened right here at the end of September. Now that could be early warning on earnings, or could have been earnings. I don't know. I didn't really research it. But what you have here is, because this thing did not break up during this uptrend, but broke up during this downtrend, this is considered a runaway gap. And in my teachings about runaway gaps, is they're the kind that usually will take months to fill. Okay, so you can see right after the emotion gap up, the huge emotion gap up here, right about there. At this emotion gap, okay, retail or investors, whoever you want to call them, got out of the emotion mode and got into the logical mode, and did some financial statistics and found, and brought the thing down. But it turned right around and bounced and gave you your V bottom, never filling this gap. So this gap still needs to be filled eventually, over the long term, eventually, looking at the bump and run. Whoops, I still didn't get off of that, sorry. Looking at the bump and run, combining it with this gap below, long term, long term, not midterm, long term, we still have to expect that eventually this is going to come back down to the lower trend line. Now we have a gap below still sitting there, saying, reinforcing the fact that it should be coming down. Now up here we have another tiny little gap. We have a short-term pattern of a V bottom reaching first target. Your first target, okay, in a V bottom pattern, which I've just got done teaching, you come down, you go up, you expect once you reach the first target, which is previous high, you expect the momentum to carry it up, then wash back down, and then if everything's hunky-dory with the investment world in this stock, then it will take off again and break your top resistance and eventually just keep climbing. Now, if for some reason that isn't what the case is, what will happen once it bounces down here is it'll channel and then come back down to the line. So what we're doing right now is we're looking to see if this thing's going to wash back like normal for the short-term pattern, and it's going to continue as expected for the V-bottom midterm pattern, or whether it's going to come back and start the pullback, the long expected pullback. We'll go again, the long expected pullback. There's your weekly, there's your trend, there's your up, your pullback, your up, your pullback. Is this going to be up in a pullback, okay? Or is it going to be a shorter term wash back and continuation? That's where we're sitting right now. So that's why if you looked at my evaluation, I'm saying that you should put a stop, because you do a technical. Now we'll get into the technical evaluation of short term. Okay, the technical evaluation of short term. We have entry and exit indicators. My entry and exit indicators are the DMI and the 5, 10, and 20. The 5 is the blue, the 10 is the red, and the 20 is the center line for the Bollinger Bands. So early indications in this one is when the 5 crosses the 10, it's an early indication to enter. When the 10 crosses the 20 and they're all lined up in order, 5, 10, 20, okay, that's a confirmed indication. So right here, when it bounced off the 20 and they all separated, and you have the 5, 10, and 20 lined up in order, right here was the confirmed indication to be in this stock. Right here, with the DMI, directional movement indicator, when the green positive DI crosses above the red negative DI, that's your early indication for entry. So right back here, we got an early indication for entry. The confirmation using the DMI for entry is that when the ADX line turns up with the upper line. So right around here is where the ADX started coming up. So you actually were getting your confirmation to be in this stock right around here. Okay, if you look down a little bit further, that is right where you're getting the confirmation with the 5, 10, and 20, where the 5, 10 crossed the 10 and the 10 crossed the 20. So right around here is the overall play that with your entry-exit indicators telling you should get into this thing. So we'll go back a little bit down further and we'll look at our support indicators, which is our Scotch RSI and our CMF. Now you're seeing right back in that area where the entry-exit indicators told everyone this is where you get into this, okay? Your Scotch RSI is going into be in mode. Anything above 80 is telling you be in for support, the be in the stock, and anything below 2 is saying be out of the stock. And down here, what we're seeing is, gee whiz, the buy pressure on this is your center line. Anything above the center line is positive buy pressure. Anything below the center line is negative sell pressure. But down here, we're getting a conflict in our support indicators. Okay? Instead, it's telling you to be in, but people are still selling out. So what that's saying is the retail mindset on this is it doesn't really deserve this climb. Okay? And what's happening is the people that don't really think it deserves this climb are selling to the people who thinks that this is going to continue. So what that means is right here you're seeing a conflict in buying and selling, which is normally a point or indication that there's accumulation taking place. Okay? When you see conflict in the support indicators, it's an indication that someone is accumulating pre a positive mood. Okay, so back here is where everything is starting to take place. Over here, we're going to go back and we're going to try and evaluate what's recently happening. What is, to evaluate whether this thing is going to retrace down or wash back to the V-bottom line and then continue or not. So there is nothing here indicating that the ADX line is going to start coming back down. So that is positive. There is nothing in the 5, 10, and 20 indicators that are indicating it's starting to turn and come back down where the 5 would cross the 10. That would give you an early indication that yes, this may be a turning point. We're not seeing it in the entry-exit indicator here. We're not seeing it in the entry-exit indicator here. We're not seeing it in this support indicator, and we're not seeing it in this support indicator. So very short term, the past 3 or 4 days, everything about this is saying, Chuck, you're wrong. Don't worry about this gap up and come back down. Everything is telling you that it still should continue up. Logic is telling you that a V bottom has momentum carrying up, wash back down, and then a continuation. So logic, and when I see the gap open and run right back down with the short-term pattern, I'm concerned, let's put it that way, that this is going to start washing back down. So right now, you take all this together, you take your long-term bump and run telling you that eventually this is going to come back down to the lower trend line, okay? Eventually, this is going to come back down to the lower trend line, long term. Midterm, where's my gaps? Midterm, this gap is telling you if this does come down here and not continue, this gap is going to pull on it, and this gap is going to pull on it, and instead of it continuing up, the whole damn thing is going to take the long-term view and come back down to the trend line. So we're right here. We're at a real decision point, and that's why in my total evaluation of this thing is right here at 90.50. If this thing comes back down and crosses 90.50, there's a very strong possibility that all the mid and short-term indications on this, the V bottom is a short-term pattern, the gap, runaway gap is a short-term or a mid-term pattern, that they may catch hold and it will never continue up. Okay? So I'm saying put a stop right here. You put a stop loss at 90. Now, if this thing comes down and these negative mid and short-term indications and the negative long-term indication don't catch hold, it will continue up. So you're safe to just hold it. So if you put a stop loss here and we come back down and the negatives catch hold and it comes back down, you stop out and you take your profits. If that doesn't happen, because I'm saying this is a decision point now, this is a very close decision point. You don't know what's going to happen. The TA is saying it should continue. The patterns are saying there's a possibility of it not continuing. So the stop loss is a logical decision. So we covered positive points, negative points, long-term points, long-term and short-term expectations. So what I'm going here, I want to use that term expectations. We should expect midterm this gap to fill. We should expect long-term a price retrace to the lower trend line. We should expect short-term a V bottom up, wash back, and continuation. And all our T indicators are supporting that, okay? But the pivot point is if this V bottom, which is now support, is broken, the whole ball of wax could fall apart and we'll end up back down here. So what we do, if we're an investor, okay, we take our position, which was originally a long-term position following a long-term trend saying $80 eventually, years out, or 1 or 6 months or a year or 5 years out, eventually this is going to hit 120 someplace. We hold a core position and we take a portion of our position and we swing trade it, saving money here because we know it's going to come down. So I'm going to fall back on my thesis that if you're a long-term trader, you get synergy in swing trading the long-term hold. So there's basically my evaluation of everything. The other thing I want to get into just a little bit is the philosophy of a long-term trader. Long-term traders can't just look at a chart, make a long-term decision based on the chart. Now, we're going to come back and we're going to look at a monthly chart, okay? there's absolutely no reason why a long-term investor couldn't look at this chart and be completely happy with this thing and say, God damn, why not? I mean, you know, it's doing perfect. It's a long-term investor's dream, that chart. But you have to know, you have to choose the proper entry and exit. You have to also consider whether the stock offers a good dividend. Okay? We've never discussed dividend. I've discussed that if you hold a long-term position, a core, and swing trade, okay, while it's climbing, that a synergy of adding gain to a basic gain line, okay, will increase your overall long-term gains considerably. Well, in the same respect, if you're going to invest in a stock, you want a stock that has a nice dividend, because that dividend alone, even if you do not swing trade it, the dividend, okay, will also compound and long-term increase your overall total gain. So when you're looking at evaluating a long-term investment, there's several things that you should keep in mind. Okay, one is for entry and exit. One thing that you should keep in mind is, what is the PE? Okay, how much? No, let's get off of that. Dividend. I want to get back on dividend. Your dividend, okay? You're gonna hold a long-term position, and you're going to want to have a dividend at least equal to what you can get on a bank CD. That's my personal opinion. Okay? Right now, bank CDs are offering around 2%. Okay? Nike is offering 1%. So Nike is on a dividend long-term investment. Nike's a little weak on the dividend end for a long-term investment. At least it has a dividend now. The next thing you want to look at is the PE. Okay? You're looking at a long-term chart and you're saying this is great, but is the PE, which is the premium investors pay to own a really good stock, okay? Is this PE really high? If it's really high, then there's a possibility that in the sector or industry, people might start saying, no, it's peaked. And long-term investors may start taking with a small dividend, okay, and an unusually long extended climb, especially when you have a bump and run. Long-term investors may start bailing out of this one, liking the sector, liking the industry, okay, and moving into one that has a little more potential long-term. In other words, we're saying if you have a large PE and a small dividend, okay, there is odds that there may be a change in the long-term investment philosophy about this stock. So you have to keep this stuff in mind, because if you decide you're going to invest in the stock at a peak, you're going to end up with a long-term loss. So let's evaluate the PE compared to the dividend of other people in the industry. Valuation. Okay, there's your PE. Okay, you're in the same industry. So let's click on PE and let's look at how our stock, which is Nike, stands as far as the PE is concerned. As you can see, the PE on this thing is the largest of all of them in this industry, which means that it is got the largest odds that people are going to start bailing out of this one, saying the premium just isn't worth it. Okay. Let's go back to, I think it's financials and our dividend. Let's go back to our dividend. And looking at this, Nike is offering one of the lowest dividends. So we're evaluating the fundamentals of this stock for a long-term investment. What I'm seeing here is Nike is overextended with a small dividend return for a long term. Okay? Others have a better dividend and a smaller PE. So I'll make a decision. I'm an institutional guy, and I got $1 billion of my fund in this stock, and I'm saying we're getting overextended and we're not getting the benefits of big dividends. Let's pull out of Nike now at the high, at the peak. You buy low, you sell high. Let's pull out. Let's get into somebody else in the industry that's a little in the mid. It's got more growth potential, got a little bit better dividend potential. So doing a long-term investment evaluation of the fundamentals of the stock, this is not where you want to just first enter for a long-term position. This is where you want to enter for a mid-term or short-term position. So my overall evaluation, looking at everything, is Nike, okay, should have a stop loss at around $90, $90.50. And if that thing is broken, odds are long-term long-term psychology is going to start changing on this. And the people that have big money invested in are going to start watching everything start to pull back and go down. So Nike's at a decision point right now. I'm not too strong on it. My personal opinion is, because of all this bull that I'm expounding here, that you're looking at a very strong possibility that this is going to be, in the next week or two, the perfect time to get out of Nike and start looking for a new buy and hold stock. I like Ford. I like HP. Ford and HP. Let's go show you why I like Ford and HP. Okay. Here's Ford. Ford's at the bottom. Ford's had a nasty time fall down. Okay. Let's look at it for long-term investment. The PE is very small. It's got a lot of room for growth. The dividend is 3.5%. It's higher than a CD rate. So right there, just evaluating the fundamentals for thinking about getting into a longer-term investment, these two factors right there are much better than Nike. Now, you want to get into taking a look at a short-term chart for Ford. Ford. Okay. Right here, what do we got? We have an ascending triangle starting. Ascending triangle is one of the most reliable short-term charts there is. As you can see, let's go into a Java chart, or I can draw some lines on it. Okay, as you can see, there's our chart, there's our trend line, there's our cycling down and down and up and down, and down and up. So this thing should be breaking out. Okay, here's your next resistance line right here. you take your price swing from the start and add it to the top, and you're back up here. So the chart is calling that you should be expecting this thing to break out short term, and you should expect it to get to here, okay? And our next resistance isn't until, let's get rid of this. Our next resistance isn't until there. So you really should not be expecting a stall in any breakout until you reach around 1625. So you could swing trade this, okay? Then you have a gap above that, which is another magnet pulling it up, okay? So you have fundamentals that are better than Nike. You have a stronger opportunity in the charting, in the short term and the midterm charting, that it's going to climb and have a good comeback. So I like it. We can go back. And if you take a look at HP, you're going to see the same damn thing. Whoop. HP. Okay, let's go down and we're looking at, again, a 3% dividend, at least a 14-point PE, just for kicks. What the? HP, there we go. This is oil and gas distributor. We take a look at the evaluation and look at the PEs for this sector. Okay, so we had a PE in the 3 area. We have a high PE. Let's go to the next one. Some of them are up into the 20s, 30s, 40s. So there's plenty of room for the PE to grow on that stock. It looks like it's getting a bounce on that stock. And it's got a dividend that's bigger than today's CD rate. So they're the two that I'm a little positive on for position trade, a 3-month hold. And Nike, I think it's time to get out. Okay, I hope all this bullshit helped you understand how I look at things, and maybe gave you some ideas on how to evaluate long, short, and midterm.